Thank you, everyone, for joining us today. That saved me from having to do introductions, so great. Let's just get right to it. So our panel today is all about driving returns in a world of heightened volatility. And I've discussed this with all three of you. It's a little bit of a misnomer, though, because if we're just looking at absolute levels of volatility, be it currency volatility, the VIX, or treasury volatility, it's not actually all that high compared to historical levels. So we'll discuss that a little bit more. I know you have several views on this, but just as a general opener question, how do you think investors should factor in volatility in their investment process? Pascal, how about we start with you?
Uncertainty is on the rise, but fear is not. If you look at the implicit volatility in the market today, equities or FX, to an extent it reflects the carry strategies. They are sellers of volatility, and they have put pressure, downward pressure on volatility. So we are left basically with a situation where we are seeing more low volatility, more high volatility. So this boils down to an important point for me, actually. Don't look at averages when talking about volatility. Averages don't matter, actually. What is important is the barbell distribution. This is not a normal distribution. And the fact that we have moved into a regime where we are seeing more low volatility and more high volatility in relation not necessarily with fundamentals or politics, etc. There is no obvious correlation, historical correlation between politics, fundamentals, and volatility. Actually, volatility was not that high in the Second World War or during the Cold War. For example, what matters is the ecosystem. Volatility is very much linked to market structure shifts, problems in the market liquidity, for example. I do think firmly that there is a correlation between volatility and the deterioration in market liquidity we are seeing around. So, and the fact that you've got players like CTAs, CPPIs, target volatility funds, this kind of animals, and they are part of the ecosystem and the market structures.
Mark, I know you have thoughts on the drivers of this current low level of volatility, even though Pascal warns us to not look at averages. But it can't be argued that in terms of just the levels, it is quite low compared to, say, the 2008 crisis, as we can see from this graphic here. What role do central banks play in that, do you think?
Yeah, well, we think that the central banks clearly are suppressing vol most of the time. So I think we would agree on that. And that's one of the real drivers that has changed since the financial crisis. And it's interesting now. I think we do get these times like this week where you think about vol and ways of playing it. So, on the one hand, we have the central banks, but on the other hand, we've got this potential for a trade deal coming up. And so one of the things that we're looking at this week is, given the way that skew is, can we use some call options and fund them, maybe somehow to play the chance that we get some kind of an outsized trade deal. So we've been, I think, volatility has changed, as Pascal said. Every once in a while, you do get these opportunities to play we find an opportunity outside of this kind of central bank corridor that we think is ripe. And so we have been doing more with options even in our large discretionary portfolios.
Okay. Sheila, I know as a student of derivatives and given your background, but also you're kind of macro in a sense that you're looking at asset classes and investing on a global scale. Do you agree with Mark at this point that it is worth a look, at least looking at volatility options strategies to hedge your portfolios, or is this something that maybe investors are worrying too much about at this point?
Well, look, I think the word volatility itself is imbued with so much meaning to the average investor when they watch it on TV or hear about it. And we have to separate the emotion from the fact that volatility is an asset and can be traded, just as Mark mentioned. I think as people look at it today, and actually if you go through the last couple of years, we've had many clients say to us, should I hedge now? What about now? How about now? And in reality, the better answer has been raise your cash a bit or do some other things, right? I think that the opportunity, which Mark rightly mentions and Pascal alluded to as well, is think about when volatility is an asset for you that you can trade. Think about when it might make sense to write some calls to take advantage of heightened volatility to generate some return off of some positions, et cetera. I think the current vol moment is a bit hyped versus the reality. And again, we get caught up in averages, history. If you look at seasonality, October is always high vol. Okay, October is earnings, October is people looking into year end. There are so many factors that go into it. But I think if we separate the emotion and just think about it from a trading perspective, there are definitely opportunities.
Pascal, what do you think?
Yeah, I agree. If you consider that volatility is the disease, volatility is also the remedy, actually, through strategies of directionally trading volatility, the volatility of volatility, etc. The big change seen from my window is this risk gap short, this flash problems we've seen in 2018 in relation to this skewness of volatility, and this is part of this new regime, I would say, of volatility.
Okay. And Mark, do you think the skew, it seems that we're seeing more extremes, as Pascal is alluding to, do you think that's the reason why you and your clients are probably asking for more vol hedges at this point? Is that something that has occurred more frequently as opposed to recent years?
That's a good question. I think that naturally, as we move into this lower rate environment that we've been hearing about, investors need to get more sophisticated or look for more ways of finding returns, or in many cases, they have learned about new fears, like they read the medical school textbook and they've got a disease that they didn't know they had before, kind of thing. And so, as Pascal said, that they're looking for new solutions, and in some cases, I think Sheila's right that in many cases, trying to play vol is not the answer for a lot of people. Maybe it's more cash, but you do find these scenarios now where, because things can be set up around, say, I don't know what's going to happen this week with President Trump, but it's going to make headlines. So that might be an opportunity where vol is the right way to play a specific event, but not necessarily change your overall allocation.
Okay.
There were Twitter VIX. I think it would be very popular.
There you go.
Twitter VIX, there you go. Something for our Bloomberg Index department to consider, maybe. But yeah. Well, all right. So let's take it away then from kind of the more short term and let's go into your broader asset views. I know each of you have your thoughts on kind of your favorable assets at the moment. So maybe we could start with Mark. I know that UBS, for instance, likes European IG and EM currencies at the moment, as well as US stocks and Japanese stocks. Which of those asset classes do you think are kind of most exciting to you at this moment?
Yeah, well, exciting is a word that it certainly gets the adrenaline going, trying to do an asset allocation right now. And I think that's because we're underweight equities globally right now, which is always a very difficult position to be in. And it's certainly been a very, very difficult position since the financial crisis. But I think the reason that we're positioned that way overall is because we think that the central banks can help prevent a recession by providing some monetary stimulus, but probably not enough stimulus near this zero lower bound to really excite risk assets over the near term. So we don't think that Europe is really going to deploy the fiscal stimulus necessary to really ameliorate this slowdown. So we think that, broadly speaking, something like the S&P 500 is range bound. Maybe there's some downside for EM equities and European equities relative to the U.S. in this market.
Okay. What about you, Pascal? I know Amundi is still a big fan of emerging markets, but you and I have spoken about kind of rethinking strategies for emerging markets and thinking about the traditional categories, and perhaps maybe it's time to rethink those. Could you tell us a little bit more about that?
What I think is that as long as core bond yields stay at equilibrium at extremely low levels, and they will, in this current regime. The only game in town is to pick some yield somewhere in the system. It's a relative value game, trying to exploit setbacks, etc. And this will change at some point. This is all about a regime shift down the road when maybe central banks will monetize directly budgetary deficits and revive at some point inflationary expectations. But this is not the current game. Short term, actually, I think that too much is expected from policy mixes across the board. So there is room for disappointment on the bond side, so more volatility on the bond side and less support for risky assets. We've been scaling down risk across the board, adding duration across the board, long DTS, obviously, on the credit side. We are not favoring one asset class, actually. What we are favoring is a couple of themes, like what does it mean to be invested in resilient equities? So answer one is to be long situations of strong internal demands in the emerging market space at a time where you would like to be insulated from the winds of global trade. This is one example. Value is another example. Second theme is sustainability beyond ESG, sustainability of balance sheet. So what does it mean to be selective in the credit space? Moving away from high yield US into the securitized, for example. Sustainability of fiscal paths. In the emerging market space, what I like at the moment is basically situations where I'm isolated from global trade noises, so basically endogenous or autonomous internal demands, coupled with good visibility on the fiscal path, and ideally high-yielding currency, actually. So the question I'm asking myself, looking at risk premium, am I well remunerated for the risk of depreciation of the currency? Actually, the winner is Indonesia. Is typical investment case, ticking virtually all boxes. Hard currency, local currency, FX. But not only Indonesia. You've got India, you've got Brazil, Russia. But this is the way we are thinking. We are long emerging market. That clearly at this point in the sky will stop here.
Yeah.
I know.
I know you agree.
On that actually, because we're long EM debt as well. But I think what's so interesting about the place we are in the markets is wherever there's an opportunity, there's both a flood of supply and at times a flood of demand. But if you look at EM debt, this has been the biggest year for issuance that we've had. And in September, $88 billion was issued, which was quite a record. Probably only close times were 2 different months in, I think it was January and April of 2018. So definitely, from an EM perspective, it's also that the issuers see the opportunity and see the chance to sell into this demand. That's fine, and it's still a place, I agree with Pascal, where you can find yield. I think when, just picking up on another point he made, when you think about risk and people scaling back risk, and I agree, we see that globally as people look at their asset allocations or actually move increasingly to risk budgeting from some of the pensions and so on. They're trying to balance these factors, and yet there's one bucket they've increased regardless, which is their private investing, where there are liquidity issues, where from a risk perspective, perhaps this year is starting to expose some differences of opinion on valuation as you see a few of the private companies try to go public and where that's ended up. But the round after round of financing, and again, the amount of capital going towards those markets, I think is another interesting risk that many clients are facing with their asset allocation.
Well, speaking of asset allocation, I suppose we have to go into discussion a little bit from the angle of the state of the industry as well. In terms of, we know the long-standing debate between active versus passive, and investors still kind of wondering constantly, should they be more active, should they go with more active managers, or is it enough to have somebody who's tracking the S&P 500 year to date which still does offer pretty decent returns. You can't argue with that. Is that enough for investors? What are your thoughts on this, Pascal? How much should investors kind of consume themselves over this debate?
Actually, the environment for an industry is positive in the sense that you've got an amazing excess of savings and reserves actually parked in low-yielding securities across the globe. And part of our business, our job, is to channel this excess of savings into various types of formats and solutions. So one challenge on the retail side is to shape retirement type of solutions. This is a booming exercise in relation with the situation for interest rates. The second axis, more on the institutional side, is the fast rising space for strategies of continuum, basically thinking beyond the distinction between liquid and illiquid. So typically the credit continuum types of strategies. So I do think firmly that the classic distinctions between passive, active, liquid, illiquid are more and more blurred, actually. What we've got to deliver at the end of the day is less and less a single unique product of the old world, and more basically assembling various types of bricks beyond the classic distinctions of active, passive, liquid, illiquid. So those are powerful trends. And just to conclude on one thing on the environment. 3 years ago, I was telling my teams actually about expected returns. I was making the following calculations. At trend, I was expecting a 50-50 global equity portfolio to deliver the following return. On the equity side, 2% dividend yield, 5% earnings growth. I was making the assumption that PE would be unchanged. And on the bond side, it's a function of the current yield to maturity, let's say 2%. It was the case 3 years ago. 7 plus 2 divided by 2, 4.5. It was already challenging and twice less than the average of the last 2 decades, actually. But now it's trending even lower, actually. And this before inflation, fees, and taxes. So if you got with this little equation, basically the bulk of the equation in this industry. Something has to go in terms of pricing structures, clearly. You've got to work on the one side, on the equity side, to enhance returns. I'm talking 4.5 at best. Actually, the reality at current trend is 3%. If you add up the average fees, taxes, and inflation, actually, the bird doesn't fly. The rest is just the consequences to be drawn.
All right. Well, Mark, what is the conversation like with UBS clients? Are they as consumed by this whole active versus passive debate? Are more and more people kind of wondering maybe they should take a greater role in actively managing their assets?
Well, I think there's a couple ways into that, but I think the point that there is an enormous amount of savings out there. Clients hold large allocations to cash at the moment, even though many of these clients face negative yields to hold those kind of levels of cash. And the need for advice is greater than ever because the world is an ever more complex place. I think that's one side of the discussion that you have with clients. Now, the asset management industry is concerned with this debate about active versus passive, public-private, all those things. But we know that also that for a client, the most important determination of their returns is the asset allocation, not passive versus active. And so I think bridging that gap is the role that we try to play in wealth management and in the CIO office because they are slightly different things. And so you find that many clients, even if they had access to the best fund in the world, they'll buy too much of it when it's going up and then sell it at the low, the behavioral gap of 3 to 4%. And I would suggest for the asset management industry, that 3 to 4% gap that clients experience versus what the fund is actually delivering is a very healthy margin where everybody can win.
Okay. Sheila, I know you're a believer that this is a great environment for active managers, but always the question is, where do you find alpha? And where do you think active managers can find alpha in this?
Yeah, I think Mark and Pascal have covered a lot of the opportunity set when you think about active versus passive in terms of some of the things you can do. I think maybe 2 points on the active versus passive debate. First of all, I think there's a very interesting dialogue that's been going on with some of our largest, institutional clients, or that some large institutions have said publicly. For example, GPIF in Japan has said publicly they want to go more active because indices represent old companies with, less growth potential, and as a steward of their own economy, if they invest in their own economy in the old companies versus in a more growth-oriented style, they're actually not helping funnel money to the companies that can help create jobs, help the economy, et cetera. Now, you can debate that a lot. There's great academic debates about that and so on. But I don't think anybody would argue with the fact that the classic passive indices, which haven't changed since 1970, are kind of, your grandfather's car. Maybe it's cool to look at, but if you really want to get someplace, you probably get in a new car. So what can you do, right? You really need to think about what are the drivers, as Mark and Pascal have been mentioning, and I think the thematic point is really critical here. What are the drivers of real alpha going forward? For example, a couple of things we've looked at are, where is wealth going? Millennials are holding the greatest wealth in a generation. What do they spend their money on? It's totally different than your grandfather's S&P. And by focusing on that thematic and investing in the companies where we thought millennials would be the most active, we've actually found a great alpha generator, right? But that took a lot of different thinking than you see in the passive style debate. I think we'll see the same kind of thing in the ESG question, broader than just equities, and it's 2 parts. One part is certainly, do you believe in ESG? Do you believe in climate change? The pace of it, how you want to invest, should that be impacted? But the second piece is, whether you believe or not, how will it impact the environment in which companies operate? Will they be stranded assets? Will they have issues working within new regulatory frameworks? How will that affect your investments? So there are a lot of cross currents where you can find both value and where you should be evaluating risk that passive just won't capture.
Okay.
Sorry, I just wanted to pick up on that because I think there's a lot of really good points in there. So when we wanted to respond to some of the forces you talked about, we looked at doing more in the sustainable investing space. And what we found was that unless you have a benchmark that investors can allocate into or against, you'll never grow that asset class. And so we actually found ourselves creating new benchmarks, new strategies that could be done passively so that others could do them actively. But I think, so the 2 sides need to fit together.
I definitely agree with that. In talking to index manufacturers, the MSCIs, the FTSE Russells, they have more demand than ever just for indices, just for benchmarks, so institutions can figure out what to do on this space.
Pascal, you look like you're gearing up for it.
No, I fully agree. Actually, just to mention some forces at work seen from my window, I think that we are seeing forces pushing ESG into the classic metrics of the business, so risk-based, alpha-related types of strategies. So this is one trend, actually, and it's a sea change. ESG, for example, I think that we will see a rising convergence of ESG into the factor-based space. We will realize down the road that part of the ESG space is deeply correlated with some classic factors we already know, like quality. For example, this is one trend. The second, I think that we are seeing some kind of a redefinition of the alpha space under the push of factor-based strategies. Alpha is not disappearing at all. It is redefined and focused on what is idiosyncratic about performance, what is coming on top of simple, consciously or unconsciously managed replication of some factors. Actually, so this has profound implications, because what is idiosyncratic about talent is not that easy to define, find, and manage. So those are two areas of interest.
Okay, this is probably a good time for us to ask our poll question for the audience, which is very much related to the future of investing in the future asset classes that we might see, say in the next 10 years. And so we're asking our audience, and I'll put this question to the three of you as well. In 10 years, which of the following investments do you think will yield the biggest returns? So the first is cryptocurrency, the second is ESG, and the third is private infrastructure markets, and lastly, index funds. So interesting, lots of interest in ESG and private markets, kind of, yeah. So I know Pascal and Mark, you both are very much into the ESG space at the moment, Amundi and UBS. Tell us a little bit more about kind of what you've found are the challenges at the moment, and do you agree with the audience that it has the potential to yield more than, say, index funds or crypto? Pascal, how about we start with you?
But there is no contradiction between indexed management and ESG, actually. So it can be ESG.
It's a subsect of it.
So,
yeah.
ESG is about extracting some kind of risk premium down the road. ESG should be seen as a pool of risk factors poorly remunerated, like carbon, for which the probability that risk materialize is high enough to take action now as a medium to long-term investor. So this is the way I look at ESG. So there is room down the road and beyond carbon to extract a couple of risk premium.
Mark, any thoughts?
Well, just looking at this here, I know so private markets, the market cap of that compared to public markets, it's like 5% or less. So I know all of you are not private market structures, so you must be voting to change jobs or something like that. You all think you're in the wrong industry. But I would just suggest, right now, there's no way that all the assets out there that asset allocators have and the expected returns that they have, there's no way they can cram that into private markets and have it be the best performing asset class for the next 10 years. So I'm pretty confident that something there isn't going to work.
Okay, Sheila, I know you're a big believer in private markets. Make the case for us.
Private markets, yes. I'm not sure about private infrastructure as the top
Vehicle.
on this list.
Okay.
Well, first of all, just reading this, what I would say is, wow, this is a hopeful audience. That's great. I'm used to talking to people who are like, it's all going to hell in a handbasket. If you look at this, there's a lot of hope here. First of all, to think, and I agree with Mark in terms of the capacity, that private infrastructure will be the biggest driver. Yeah, there will probably be some great returns in that space. It's also a really interesting space, though, when you think about infrastructure in the current geopolitical environment. It's a space where international investors want to invest cross-border. But it's a space where people are worried, will we end up trapped in some infrastructure project when a certain regulator or government decides, okay, we're taking a different route and you're trapped as an investor. ESG, I think, and I agree with Pascal's point, is not incompatible with index funds. And I think from a thematic perspective is probably of that list the biggest thing that will impact all of our investing in any of these categories, in infrastructure as well, and so on. But I think cryptocurrency is interesting. I'm not saying because I think we need to invest in it, but almost because I think that it's something that we will see in the next several years central banks address. And that's why you see, already China, the Bank of China getting involved in thinking about what should a digital currency be. You may not see the Fed very happy about Libra right now, but if central banks don't get a handle on digital money and digital currency, which to some extent, touches on crypto, not exact crypto, but that aspect of it, they've missed out on something that will really change the flow of wealth going forward and the flow of payments, et cetera.
Pascal, a rebuttal on crypto.
Yeah, in less than 5 years time, I think we will look at our business as basically something about managing risk return, we know, and liquidity. Actually, this is the point I wanted to make. We learned at school that this business was about risk and return, and that all asset classes were liquid at any moment, which is simply wrong. Actually. So this business is about managing a trade-off between risk, return, and liquidity. It's coming with challenges, but also with opportunities, clearly. And I take the bet in 3 years' time or 5 years' time that liquidity management per se will be a powerful shaper of the industry.
Right, well, that sounds like a good note to end it on. Thank you very much to our panelists and to our audience as well. Hopefully, it was a good panel for you to sink your teeth into. Thank you very much.